Hey guys, this is Terry with Futures.io. It is my honor to welcome back FuturesTrader71 for today's webinar, Understanding Price Risk versus Information Risk. The bullet points for today's webinar are defining risk and why it matters, what is price risk with examples, what is information risk with examples, when is the cost of information worth it, putting this into practice, getting off the monkey bars and trading. Now, please feel free to type your questions into the questions box during the webinar, and we'll do our best to answer them at the end of the event. If you're watching this on YouTube, please do us a favor and give us a thumbs up if you enjoyed the webinar. And always, please feel free to share, comment, subscribe to the channel. It really helps us a lot. You can also follow us on Twitter, Facebook, and YouTube at Futures.io. And without further delay, I'll hand it over to FT71.
Thank you, sir.
All right, you should get the pop-up.
Same guys requesting the same control. It's odd. It's like built into your thing there. Does everybody see my screen?
Looks good.
Check. Okay, cool. So this isn't an incredibly titillating topic, but I'm going to try to show examples using the most recent market information, which is yesterday's trading day in the ES. And the reason I chose the ES is because it's the most popular product out there in the online world. But today I'm going to talk about understanding price versus information risk. This was a topic that has come up several times, and Futures.io asked me to elaborate on it because it's something I've kind of brushed up on a little bit in prior webinars. I have to start off by telling you that derivatives trading involves substantial risk of loss. It is not suitable for all investors. Past performance is not necessarily indicative of future results. So what are we covering today? Oh, hang on. I got my slides set incorrectly. Just 1 second, please. Just 1 second. Let me cancel this. Oh. Okay, just I've got my slides set up as a kiosk, which is not good. All right, here we go. There, now we can scroll our slides. Okay, so the key topics is, I won't repeat these, Terry's already gone through them. I'm going to try to use examples as much as possible because this isn't academia. We want to see what is meant in terms of market action. First, I want to define risk. Everybody knows what risk is in general. It is what you can stand to lose in its most basic form. We define risk as whatever amount, whatever is at stake for anything that we do. I want to hit it from a different angle, but I want everybody to leave with the impression, with the belief, hopefully, that risk is the only place from which opportunity exists. If there is no risk, there is no opportunity. That is just as true as the sun rises every morning, unless you live in a cloudy place like London, right? But it's one of those things you have to contend with as a trader all the time. And I want to talk a little bit about what in a minute about what traders try to do. So look at the difference between how a professional trader looks at risk. To me, and it just took a lot, by the way, for me to get there. It took thousands of trades and a lot of time in prop to finally understand that there is no way for me to avoid risk. So we spend a lot of time trying to get past or get beyond taking a risk, right? We study more, we use more better indicators, we use multiple moving averages and end up having a screen full of spaghetti lines on it and all that stuff. This is all an effort to mitigate risk. It is somewhat futile. After a point, the incremental return on your effort to do away with risk is very, very poor. It's a waste of time. So for a professional, and the way I see risk, I've been doing this for 16 years as a full-time professional trader, first in equities, high volume equities, and then futures since 2002 or 3. For a professional trader, risk is the only part of my trade that I know I can control. It is the only part. Okay, so there's this illusion that you know, I see this trade setting up and I see where my profit target is, and that's where I'm going to get out, and that's what's going to be my profit. But the fact is, the only thing I can control once I put the trade on, I can't control what the market does next, but what I can control is how much I'm willing to risk to find out. And so with every time you click in the market, especially live, you're essentially taking a small bet to find out whether or not your idea has the right direction and has the right timing. Okay, and risk is just a part of that. Okay, risk is the only way to make money. It just is. So you cannot eliminate it without eliminating the opportunity as a whole. For a non-professional, and being at stage 5 and watching risk for a lot of accounts, I know that the biggest hurdle for most people is that they see risk as this danger, right? This hurtful thing, and that they'll do everything they can to avoid this risk. And once they've taken the risk and it's not working, they'll do whatever they can not to secure the loss, not to take the loss. And so people who are otherwise risk averse, like I could tell you this with a high degree of certainty, that the people who are most risk averse are the same people who are terrible when the market does not give them a trade in their direction. So they're incredibly risk averse at first, and then once the trade is on and is not working, they're the ones who will hold on, you know, for a trade that they were looking for 4 ticks on, or a point in the ES or the NASDAQ, and they'll hold for a 30-point loss. Those are the most risk-averse people, and here they are taking a gargantuan amount of risk, right? So because risk is being seen as this dangerous thing, it is harmful, you want to avoid risk as much as possible. Let me know if this is not true in your own experience. I'd like this to be a two-way conversation as much as possible. And risk has a high emotional charge, right? So our emotions get involved, we get scared, we put the trade on. Our attention is focused on finding those things that are going to harm us by causing our trade not to work. And that's because we're not accepting the risk in the first place. Okay, so these are ingrained things. These are ingrained habits. Since you were born, your parents or your guardian has spent a lot of time preparing you and warning you of dangers all around you. The danger of dropping a glass of water, the danger of falling down the stairs, the danger of slipping in the tub, the danger of playing in the playground. There's a huge emphasis on it. When we develop into adults and we start to trade, this highly trained, highly exercised thought process carries over to trading, and it wreaks havoc on people's accounts. There are ways to avoid risk with the right system or strategy or tool. This is a belief for a non-professional trader, that somehow they can get rid of the risk if only they could get that latest order flow tool, the latest indicator, the latest measuring wiggy-jiggy widget, or whatever. There's this idea that I can dispose of risk, and therefore there's a huge market of people selling you ways to eliminate risk, but this is not, that market does not exist for professionals. Like my office at the Board of Trade here in Chicago, you don't get people knocking on the door and saying, hey man, I've got this awesome indicator that's going to make you a lot of money. I'm not getting emails from those people, but as a retail person, as an online person, you find that you get that a lot, and it's because professionals know you cannot get rid of it. You can only define what your setup is, and based on historic probabilities, define what the risk is and just take the trade multiple times. At its core, risk is a choice, right? I choose to either wait for the light, for the crossing light to change, or I step out on the street and take the risk of being run over. I take my life as the potential risk. I'm weighing the risk of getting hit by a car that I didn't see versus crossing the street sooner. This is a choice. That's what risk is, okay? So, next point, what is price risk? So today we're talking about the different types of risk. There's price risk and there's information risk. There's a quiz. There's a quiz at the end of this, and Terry is carrying a big stick that he's going to smack people with if they get the answers wrong. No, I'm just kidding. Just pay attention. This is an important thing for you to understand just on a fundamental basis. No, this is not going to revolutionize your trading tomorrow, but it's important for you to understand what you're doing in the market in terms of risk. Price risk, an example of price risk is a broker who would only recommend a stock to her clients once she sees the stock is moving up, okay? So a broker wants to recommend ABC stock, sees that it's trading. This is an example out of Mammoth's book, The Nature of Risk, a really good book. I read it in 2002, I think. Sees that the stock is trading at 42, thinks it's a good stock, it's got good fundamentals, good bright future, and is ready to reach for the phone to call her first customer to buy, 1,000 shares of the stock, and that's how she makes money. Except that as she reaches for the phone, she sees that the stock ticked down to 41 3/4, right? Back in the teeny fraction days, 41 3/4. So 41.75 is where it's trading right now. There's a little bit less confidence in the call. At the beginning of the call, it was a lot more confident. Then the stock ticks down to 41 1/4. And now she's retracting her hand from the phone. She doesn't want to call a customer because this may be a loser. She doesn't want the customer to lose money. She wants to have a good record, all that stuff. It's no longer a good trade because it's falling, and then the stock goes to 41 even, and there it is. It's bombing. Oh my God, the stock is at $40.50. Oh, it's a terrible stock. I just saved myself a lot of hassle. Glad I didn't recommend to my customers to buy it. And then the stock turns around and it starts going to 41, 41 1/4, 41 1/2, 41.75, and it goes back to 42. And now she's a lot more confident. She's like, see, it's going up. It's going to go up. And she reaches for the phone again, and she thinks, well, wait a minute. I want to see it break through 42 before I start to make these phone calls and get my clients to buy the stock. This is where it was before, this is where it got stuck. Maybe it'll stop here and turn around again, and then we're in a loser. So let's wait for it to break away. The waiting for it to break away is what's called price risk. You are waiting for more information and accepting the risk of a worse price, okay? And so it's really important to make the distinction between what kind of a risk are you taking on this next trade. So the stock pushes through 42, runs some short stops and some buy stops, and it's trading at 43 and a 43 1/4, and she's frantically calling everyone to say buy it, buy it, buy it, because the stock has proven, we've got now a lot of information to show that the stock is working in the direction that she had intended, except that the better price to buy it at was probably $40.50. But we waited for price to show us more information, and so we physically traded in price risk for more information. And that's what price risk is. It's when you take a trade away from the ideal price to keep your risk down. The biggest issue with price risk is that it puts your trade relatively far away from your stop, okay? The definition of price risk is when you give up better prices in order to receive more information. And we're constant, not only do we trade on value in the market every day through the auction, no matter what you trade, you're trading value. We are constantly trading this back and forth. We are trading this process of giving up information for a better price or giving up better prices for more information. Back and forth, back and forth, back and forth. And achieving a balance gives you a plan that supports your edge eventually. And that's the goal. What is information risk? Of course, is the opposite. Trader who waits for the market to bounce before taking a pre-planned trade. Hey, I want to get long. I'm not going to get long in the support zone that I've defined and I've been watching for weeks. I'm going to wait for the market to just bounce. And so this is a trader that's taking price risk, but the information risk is when you step in knowing, hey, I have a probabilistic based on history, I have a probability that this trade is going to hold. I don't need to see it bounce. I'm just going to go ahead and rely on my homework or research or probability or whatever it is, the setup, to take this trade at the best price possible. So you're taking information risk. You're not going to wait for the market to bounce before getting in. You're trying to take a better price by giving up more information. The biggest issue with information risk is that it needs a very clearly defined action from the market in order to take the trade. You have to predefine and be very confident in what you're doing in order to trade on information risk. Okay, so automated systems may wait. For 1, 2, 3 things to set up, but if they're waiting for 20 things to set up, they're taking huge price risk, right, and not enough information risk. But if an automated system gets in as soon as the first thing happens, then they're taking a lot of information risk and not much price risk. So that system may have a lower win rate, for example, but when it does, then the program has to be offset. The outcome has to be offset because the stop is much, much smaller than somebody who's waited for more and more information and got worse prices. So definition of information risk is when you give up more market information in order to get prices closer to your stop area. Okay? So you have to think, which one are you? When is the cost of information worth it? So your job is to, one of the things you have to do is, as part of your plan, is to balance both types of risk. There's hardly anyone who is, unless you're trading randomly, there's hardly any way to eliminate either one. You're taking some level of information risk and some level of price risk, okay? So your job is to offset these. I'll tell you, on some trades, I will take information risk and I'll just hop right in because I see a zone, a confluence zone. I don't need to see the market turn before I jump in. On others, I may take price risk and wait for the bounce and the pullback and a formation, you know, and a corrective formation before I jump in. And I'm taking more price risk, but I have better information. And it's just this thing that constantly shifts. It's a scale that's going back and forth, right? And the issue with people who are inconsistent, with traders out there in this audience or whatever, who are inconsistent, is this kind of mishmash that leans much more towards price risk than information risk. So in general, somebody who's not confident is going to lean on price risk a lot. They're going to wait for worse, they're going to wait for more information. This is what we call in trading confirmation. You're waiting for confirmation. You want to see what the market is going to do before you jump in. But the fact is, by the time you jump in, the market has already had a good portion of its move. Sometimes 50% of the move is done before you get that confirmation. And your job is to cut back on that price risk and give up some information and get in sooner so that you're tighter and closer to your stop or the area where you would be wrong. And this is a very difficult thing to do in real time, but it takes time, it takes practice, and the only way to get there is really to take as many trades, to have a predefined, a very clearly defined method of finding those setups, having a predefined and clear plan for the day. What is your big trade of the day, right? What are the key trades that you're looking for today? And then have a clearly defined action plan once you see that, and then you just basically define how much risk you're going to take. Okay, on this trade, I'm going to take a 2-lot. I'm risking $350 on each trade, and my goal is to a return of about $700 for every $350, and then just put it on, let the market find its way to your target or find its way to your stop. There's no way to tell. You cannot be all price risk or all information risk in trading. You're a balance. You're somewhere. You're a mix of one or the other. When is the cost of information worth it? Oh, looks like I duplicated the slide. Okay, sorry about that. So I want to show an example real quick here. I'm going to set up a trade for you. 1 second. I closed the picture by mistake. So this is, for those of you who may not be familiar, I do this thing called the Trader Bite every morning. And it's a pre-market broadcast that I do that looks at what the market has done, how things are shaping up, and what's expected for the day. And I'm looking at, you know, I'm looking at 5 main trades for the day, and I order them in the order in which they were likely. I call it a Trader Bite. You can find those on YouTube. Just go to YouTube, do a search for FuturesTrader71, subscribe to the channel, you get notified that when the Trader Bite is happening. But every morning at 9 o'clock Eastern, I come in, I look at what we've done. This is yesterday, okay? This is an RTH only chart. This is yesterday. In this case, this is Friday, so I'm using Monday, and I'm planning out Monday's trade. So this comes right out of this video that's already been recorded pre-market before I saw what the action was going to do, and this is hypo number 2. This happened to be the hypo that worked that day. And so I come in and I look based on my knowledge of how the market auctions, the way the market moves, and so on. And I've talked about this material a lot on Futures.io. Just look for my videos, and you'll see that I've basically broken down what I do down to a lot of details, except to say click here. But the expectation yesterday was for the market to open choppy, you know, just sideways, push up towards the prior day's point of control. The point of control is the most traded price of the day, and then pull back, then fail, make a lower high. This is what's called a corrective move, and then I'm looking to trade this leg here. This is the big money leg right here, and if I miss this leg, then I'm looking for a second pullback for an attempt at the prior day's low. Okay, so I get a second chance here. That is the key. That is one of the key trades of the day. Okay, so that's the setup for the trade that I'm about to look at. Here's what it looked like. Hang on, let me bring this control panel closer because I keep having to go across 4 screens. Here's what the market looked like when it opened. So this is what actually happened. There it is. Chop, push up, right to the point of control. We missed it by 2 ticks. Okay, remember the image right there, right there, right there, right there. So this was after the market opened. So what you saw here is the plan before it opened. Here's what the market did after it opened. This is when the day was done. So I didn't know this was going to happen. This was just a plan. And the market pushes, so it has a choppy open, pushes, pull back, push, again, there it is, chop, push, pull back, push, and then break, right? And so there it is, push, pull back, push, and break. This again, this was yesterday. This was yesterday's trading, the 6th of February. And I'm looking to catch this leg. Okay, so how much risk do I need to take to participate in this move? How much information do I need to wait for in order to participate in this nice move from 91 to 83.5 in the ES? So the next step is I go down and look at what the market is doing, on an order flow basis. So here's the first test occurs right here. I'm going to fast forward here. Hopefully this runs. Please run. Looks like it wants to, but it's not. I'm guessing your screen is not moving either, right? Does anybody see this move? This does not like GoToMeeting for some reason. No movement. All right. Let's shift out. Yeah, the way this displays stuff, it does not like GoToMeeting. So here we go. So I cannot use the coloring things. So here the market is opened right there at 8:30, and it's chopped around. Here's the first test of 91.50. So if I'm trading this, so I can see that there's a fair amount of volume here. I can see that it tested the 91.50. I can see the 92 was the point of control that I just talked about here. 92 is this pink line. So I'm looking for a test, pullback, retest. And so this is what I'm seeing. This is what the market is actually doing. So I've got this set to 1 lots. It looks to me like I may have missed the trade. So my next opportunity is to rely on this area. Do you guys see my cursor here? I'm not going to color because if I color it messes up the screen. You see my pointer? Okay. So you see this cluster right here, this cluster of trading right there. That cluster is making up this little bit of quoting volume and actual volume right here. And what I'm going to do is I don't need that much information in order to take the trade on the pullback. Again, pre-market, this was my plan. First peak, second retest, look for the drop. Okay, so I can see that the market's kind of clustered here. I have my eye on 91.50 and 92. There's nothing for me to do. At this point, I'm taking too much price risk, right? I'm taking too much price risk if I sold down here, because this trade short that I'm planning on is wrong way up here above 92. So if I sell down here at 88, I've got 6 points of risk. So I either wait for the market to fail to break the low here, and it looks like it's almost failing here at 87. 87 is around the mid at that point. It's pushing around this area right here. So it's clustered right here, and I'm looking for it to push back up, and I'm looking to sell the failure. Why? Because the market has already tested higher. It's got a fair amount of resistance up top, a lot of volume, and it failed to push into that volume the first time. So I'm looking to take it the second time. So here's my chance. What do I need to wait for here? What do I need to wait for? I need to wait for this failure to take place. There's my short. My average is 89.75. I'm not going to wait very long. I'm taking this trade as close, so 89.75 is where I've entered. This yellow line is the theoretical average. And then the way I manage risk is to try to add to the trade in that zone, and then start working my scale outs ahead of the market, looking for the break. Okay, so as soon as this market touches the 87.75, I'm looking for a point on the first trade, a 1.5 on the second trade. As soon as it breaks lower, I'm going to this theoretical average, which will jump up. That's my stop. See the theoretical average. So now my stop, if I'm putting a stop, my stop goes up here, and that gives me a $0 outcome on this trade. Okay, so the next step, remember, I'm looking for it to drop. I'm looking for a pullback. The next step is to wait for it to take its drop. Okay, and the drop is likely to go to the prior day's low. So I'm looking right now. I'm looking for a break of the IB, 86.25 and 83. And so there's 86.25 already loaded, and 83. So I'm going to go 83.5. and I'm looking for any opportunity to sell again. Again, with this one lot that I have remaining, it would have to go to 92.25 for me to break even on this trade. Okay, and I'm not waiting for the market to move, pull back, and move and pull back, because I have enough information. My plan has already given me the information. I already saw it fail the first time. I'm looking for the corrective move, the second failure, and I don't need much information. I just need for it to try to push into this cluster that I pointed out earlier, this mess of volume down here, this mess of volume up here. I'm looking for it to push back in there, and I'm going to look for a place to get short. Generally, I break up my trades into multiple steps, and I look to get short and add, and then the goal is to keep as little price risk as possible and to keep my stop as tight as possible. That's my goal. If I can keep my stop tight and let a runner run, I don't have to be right that much of the time to be able to get something out of it. Okay, there's a whole bunch of stuff going on here that that I can get into with the order flow and stuff. This is not about order flow. What I'm saying here, and I hope this is a clear example, and I just thought of the most recent completed day. The clear example is here's the 91.50. My plan called for 91.50, 92 to be tested, preferably 92. I saw the size come in on this trade. So if I go back, I saw that the market is stepping in here. You see the market, the offers are stepping in. As the market pushes up, the offers are still stepping in. You see how it's turning white, turning slightly white. That's all I need. I came into the trade a little bit late because I was talking, but it's good enough. I'm not looking to catch the high. I'm not looking to guarantee an outcome for myself at all. I'm just simply looking for what could work in this direction, what could work in the direction of the trades that I want to take with the minimum amount of price risk, not the minimum amount of risk, because my risk is the same. My risk is going to be on this trade 2.5 to 3 points on the full load, and just work, just work my way around it. Now, I didn't scalp around this trade. Generally, what I do is I scalp around the position so that I can get this theoretical average line. I want this theoretical average line, the yellow line that you see here is a custom indicator that I've created. I want this to move way off the screen. That's what I'm looking for in general to happen. And so didn't get a chance to do that, but that's what I wanted to demonstrate, is you don't need that much information. Whereas other people, like some others, might tell you, okay, here's what you do. You're going to, hang on. You're going to wait for that first bounce, then you're going to wait for the second bounce, then you're waiting for the bar to close, and then you're waiting for the moving average to roll over, and you're looking for the stochastic to cross, and then you're looking for this, and that's all good. I'm not saying that that's not a good way to trade. There's no wrong or right way to trade. It's just your way. It's like the way you walk. It's just the way you walk, okay? There's no right or wrong way to walk. But I don't like to wait for all of that stuff. And what does the market care that a 5-minute bar closed, or that a 20-minute bar is closing, or that the 15-minute bar has closed below the prior 15-minute bar and all that? If you are building a plan based on statistics, and those are the parameters that you've created, that's all well and good, because then you're not trading the 15-minute bar in that case, or the 10-minute bar, or the 20-minute bar. In that case, you're trading the probability. The probability is historical, is historic in nature, but it's still a plan. You're still trading the probability. But what I see often is, hey, yeah, I'm going to wait for this bar to cross the other one, and I'm looking for a doji, and I'm looking for that. It's all well and good. The problem is, if you wait a long time for that 15-minute or doji or whatever it is for something to cross, what's going to happen is you're going to take a whole lot of price risk for more information. You're paying and trading. You're paying your platform fees, your clearing fees, your brokerage commission fees. You're paying for your exchange fees, you're paying for your time and all this stuff, but you're also paying for information. And it's never talked about, but it's a fact that as long as you're waiting for information, you're paying for it, because the price you're about to take is worse than the price that you could have taken. But I'm not saying, hey, throw caution to the wind. Hey, you want to cross at the crosswalk? Why wait for the light? Just look left and right and just go across. Don't worry about it. I'm not saying that. I'm not saying you should be a renegade about risk, but I'm simply saying you don't need that much information. If you find that you need a lot of information, you're overthinking this and you're seeking perfection. That's what you're after. You're after perfection. And it's a very, I don't know what your experience has been, and I'm not talking to anyone in particular, but it's a very, very difficult way to trade. It's a very painful and disappointing way to trade. If you're sitting there spending all of your time trying to think away or plan away risk, it isn't going to happen. It isn't going to happen. And any professional you run into who knows what they're talking about is going to tell you that it isn't going to happen. Okay, it's a fact. So putting this into practice, so that was an example. It's hard for me to talk about risk without talking about probabilities and outcomes. So those of you who are part of Stage 5 and were part of the AMA debate about the 50-50 thing, this is a really strong point that I keep going back to, and I know I sound like a broken record, but the fact is the other part of the coin, the risk coin, is the probabilities and outcomes of every trade. And because risk is inherent to every opportunity, you cannot get past, you cannot, as a trader, think about it. Go away and think about what I'm about to say. You cannot get away with anything better than a 50-50 outcome on every single trade. There is no way around it. The very next trade cannot have any outcome except win or lose. Even when you scratch, you lose. So there are two outcomes. And if there are two outcomes to every trade, then every trade has a 50-50 probability. Okay? 50-50 outcome. And when you look at probabilities, you're only looking at the past. They don't describe what's happening on this very edge of this trading platform here. They don't tell you what's going to happen next. They don't tell you that, it's going to uptick, no, it's going to downtick, it's going to uptick, no, it's downtick. It's not going to define that for you. And so the probability is just a historical thing. It's something that has happened in the past, and you can look back at it. And in the market, because you have an unlimited number of outcomes, and it's constant, then the outcome is always 50-50. Somebody's asking, how about if it's Russian roulette? It's not the same as Russian roulette, unless, of course, the Russian roulette you play changes the numbers every single time. If every single time the numbers change, in addition to the ball bouncing around, then maybe so. That's more close to what the market is. Okay? And so you have to understand that because of this, the only thing you can control as a trader is risk. So if you're sitting there taking trades, watching the market, getting itchy to do something with your time because you haven't done anything today, and so you decide, let me just go for a tick here and see what happens, you're not defining the risk. And so you're not defining the only thing, and I'm telling you this from a professional perspective, okay? This is really important. The only thing you can control is risk, and you have not defined that. So what have you done? You're just a random person trading randomly. That's all you are. And you're reducing the potential for outcomes in your trading account to gambling levels, okay? To Russian roulette levels. And so, oh, you said Russian roulette, so you're talking about a gun. And so it's just it's an important thing to know. And the best way to describe this, and I won't dwell on this point, I'm running out of time here, The best way to describe it is to say, what is the probability? So we have, I see here, we have a Kimberly. So Kimberly, if you're still with us, what is the probability, given the history of your life cycle, of what you've done so far, what is the probability that you're alive? What is the probability that you'll be alive tomorrow? So if I look at your history, Kimberly, since you have a pulse and you breathe and you're typing stuff in here, the probability that you're alive is 100%. It's 100%. It has not failed yet. Thank God, knock on wood, right? It has not failed. So that's the past. But Kimberly, what is the potential of you being alive at the end of the day tomorrow? Is it 100%? No. What's the potential that you would be alive tomorrow? A little faster, Kimberly. What's the potential? Yeah, it's 50-50. There are two outcomes. You're either alive or you're dead. There isn't a third outcome. If there's a third outcome, then your outcomes have to be 33.33% each for each type of outcome. Period. Period. So when we're looking at probabilities, I have a 97% probability win rate on a system. 97%. Wow. I should take out every loan I can. I should go mortgage my house and put it all on the very next trade because it's 90. Because I'm winning 97% of the time. I'm gonna win 97% of the time. False. You're not going to win 97% of the time. The system has performed historically, has given you a win 97% of the time. It is not at all describing what the very next trade's outcome is. The very next trade's outcome could result in a loss that reduces the 97% to 96.9%. So now your system has a 96.9% historical probability of winning. Do you see how that works? And so knowing that it's constantly a 50-50 outcome, the only thing you can control is risk. So you have to define risk. You have to not only define how much of it, but you have to have a very comfortable understanding of the different reasons you trade and how much price versus information risk. So now we're taking the risk part of your plan or of the trade, and we are breaking it down to, okay, is this the type of trade where I have to wait for the bounce and wait for the pullback and then get long at that point, but only if it breaks the high of the pullback from the bounce? You know, in that case, you're taking a lot of price risk for more information. So you have to put that down as part of your plan. Okay, I need a wider stop for this, therefore I need smaller size, I need to trade smaller because I have to make up for the fact that I have a lot of price risk here. Or I have a setup where on the first touch of the VPOC or the first touch of new highs, I am selling the new highs every time. That is an information risk trade because you're not going to wait long. You're not going to wait for the market to do anything except take out the high, and you're going to sell whatever price that occurs. And so you're taking little price risk and you're taking a lot of information risk. And then other setups are in between. Once you understand and break down those setups and how they figure in the scale of what is price risk, you know, are you paying up for more information or are you not? Once you break that down, you'll start to get a better understanding and more confidence in every single trade that occurs. If you're a discretionary trader and you're waiting for certain things to happen, you're taking a lot of price risk. That's okay. That's okay. This is how I've made a living for the last 16 years. But I understand that if I'm taking more price risk as a discretionary trader who's not just taking every single crossover or whatever, I'm not trading automated, I know that I'm required to compensate for that by reducing my size or adding to my account or whatever. Okay. The other really important thing that I see occurring with risk is people overthink it. They're overthinking it. this trade here, oh, you know, I need to, okay, what if it breaks through? What if it comes up here to the last high and it breaks through? Like, how do you know? Yeah, sure you can do this because you know what happened and you can take this trade and so on and so forth. And they're just overthinking it. What if it breaks through? Well, if it breaks through, then it goes into the losing column, and the losing column costs you whatever it is your stop, or whatever your stop is set to be, and that's it. And so don't overthink it. If you start to overthink why this may or may not work and why you should or should not, you're introducing more and more and more price risk. Okay? The other thing that I wanted to talk about is you cannot evaluate your plan based on 3 or 4 trades or 10 trades or 20 trades even. It's really important for you to understand your risk. It's really important for you to test your idea on a large number of trades. Whether it's through back tests or if you're walking it forward, it doesn't matter. But you need a large sample for you to understand and quantify risk, whether it's information or price risk. And then again, you're overthinking it. Actually, the point ahead before was you can't think it away. Like, you can't do enough homework to get rid of risk. It's not possible. It's always going to be there. The only time you have no risk is when. When is the only time you can put a trade on and there's just no risk? Anybody? No, even if it's a simulator, you still have a P&L. There's one condition under which you can click in the market and there's absolutely no risk. What condition? Click in the market, no risk. You're trading, you're clicking in the market. Come on, you'll get it. Market's closed. Close enough. Close enough. The only time you can click in the market and there's no risk is if there's no price movement. Price has to move for risk to exist. Am I wrong? Right? If there's no price movement, there's no risk. But remember what I said in the earlier slide. The earlier slide right here. What did I say right here? No risk, no opportunity. So you can get rid of the risk. Go trade the shots. It moves like 3 ticks in a year or something, you know. So if you get in there, you don't have any risk, but there's no opportunity because the market's not moving and there's no way to make money. So you can't think risk away, you can't get rid of it, and also don't overthink your trades. Now, let's do a quick quiz here just before Terry starts getting antsy about me moving on here. Let's do a quick quiz. Take 30 seconds to answer this question, please. Go ahead. So the question is, go ahead and click in there if you can. We want to accumulate your stats on your answer. The market moves towards a defined support zone. You don't know if it'll bounce early, so you buy. You have just taken what kind of risk? Okay. So let's get rid of that real quick. So only 65% of you have voted. That's kind of disappointing. Let's get some more numbers up there. Price and information risk is difficult. Remember, the market has moved towards their support zone. They bought, so they've taken a trade. They're taking a risk. What kind of a risk did they take by getting in there and just buying it? Okay, so let's get rid of that. 71% of you have answered. It's been on for a long time. Second question. There we go. So with this one, hang on, it'll pop up here in a second. With this one, the market rallies from a balance zone, so the market has rallied, right, from consolidation, rallied, where it has been trading sideways for hours. So the market's been trading sideways for hours, and it just rallies. You've been waiting for the breakout. You just took what kind of risk? What kind of risk did you take? All right. 50% of you have voted. Let's leave it up for 20 more seconds. 63% have voted. And 10 more seconds. 5 seconds. And time's up. Okay? And one last one, and we're done. And we'll go over these results. Here we go. Traders who are jumping in early are strictly leaning towards what kind of risk? It's a trick question. So 30 seconds left. It's a trick question. All right, 15 seconds left. 70% have voted. Okay, 10 seconds. All right. Okay, so here are the results. Here are the results. So for the first question, the market moves towards a defined support zone. You don't know if it'll bounce early, so you buy. There's the clue is you don't know if it'll bounce early. Knowing is information. So you don't know if it'll bounce early, so you buy it. The kind of risk that you have taken is information risk. So 64% of you got that one right. Nice job. Okay, you didn't know, so you took information risk. The second question, market rallies from a balance zone. It's been consolidating for hours, and you're waiting for a breakout, and the question is actually not complete. You get long, but only after you see a higher low. And for this one, it's price risk, right? You're taking price risk because you're waiting. The key word here is waiting. You've been waiting. Waiting means more information, so there's less information risk because you're getting more information, so there's less risk there. So the other side has to go up. Price risk has to go up. So 65% of you got it. You've been listening. Thank you. And then the last question is a trick question. Also 77% voted. The last question says, traders who are jumping in early are strictly leaning towards information risk, price risk, or all traders have to balance both risk types. The answer is all traders have to balance both risk types. So you're jumping in early, but the trick thing is here, you can never eliminate one or the other. So early may be just enough information to take the trade. Early may be just the right price to take the trade. Could be either one. The fact is, as a trader, you're constantly having to balance those two. Okay, and that's all I have for you at this moment. And Terry, I don't know if you've got any. I know there are a bunch of questions, but I'd love to end this in the next 5 minutes so we can finish in an hour for once.
All right, let me just go through and see if there's a pressing question that I think we should ask.
Wow, must be a lot of questions out there.
There was a lot of comments back and forth. A lot of the stuff we've already covered, so I'm trying not to ask the same question.
Mm-hmm.
Okay, here we go. We'll leave it with this. Is there a good way to determine which risk choice suits you best? Price or information?
Wow, that's a really good question. So, is there a good way to determine which type of risk suits you best? So, it's really in the probabilities, okay? So, here, one of two things. You might be really risk averse. You're just someone who doesn't like to lose money. You don't like to see negative numbers, okay? And so you decide, I don't want to see negative numbers, and therefore I'm going to wait for more information to get more certainty in the trade, which is a false idea. There's no additional certainty by taking price risk, because now, yes, you'll see more information, but your stop is much, much wider. You're having to risk a lot more on each trade. So it gives this false idea that you're being smart by waiting for more information. But the fact is, you have to rely on the probabilities. You have to go back and say, okay, what if I have a confluence of, say, well, however I define turning points of support and resistance in the market, I'm going to take a situation where, let's say, I always take the trade when I have 3 or more indications in that direction all happening at the same time at that area. And so you go back in time and you test, say, 100 instances of that happening. And the better opportunity may be, given the circumstance that you're in, may be to just take information risk, meaning just trade at the price of the that support or resistance area and keep your stop smaller. That way, when you do lose, maybe you lose $150 instead of $350, okay? And you lose that more often. So maybe you're losing that 76% of the time, But when you're right, the market goes 10 times your risk because you're holding that trade all day. And you test that and you find, hey, I'm okay with more small losers and which are made up for with big winners. Now I have a very strong positive expectancy. But then another person can come along and say, I'm very risk averse also, but I don't like to stick my neck out just blindly like that. It seems crazy to me. So I'm just going to wait for the market to actually set up, then retest, fail, and then go in my direction before I initiate a trade, like in this example here. Right? I'm going to wait for it to fail. I'm going to wait for it to consolidate right down here. So I'm going to wait for this consolidation. I'm going to take the break of the consolidation, something like that. That's all well and good. And now your win percent may be 68%, right? So now you have a 68% win rate. But from here to your stop point up here, the loss is much, much bigger. And so this 68% is getting you more winners, but the winners now are smaller because the target, say, gets closer versus somebody who just traded up here, right, and has a stop up here. So it's hard to answer that question without saying, well, it just depends, because it's a circumstance thing, but it's also a statistical thing. So remember, we're trading probabilities constantly. We are constantly trading probabilities. We're balancing the probability of one thing happening over another historically with the full faith and knowledge that the very next trade might have all the probabilities going for it, but it still might lose. Okay? And so it's really a personal choice. It's much like buying a car. Should I buy a minivan? Should I buy an SUV? Should I buy a sports car? It just depends. It just depends. So I would say look back. you know, define what you like. What trades do you like? Define what those are, and then go back. It really doesn't take that much work with a bar chart to go back and just find those trades and keep a little tally of when it worked, when it didn't. People don't like doing that work because they see it as hard work, but really it's a necessary part. I trade probabilities, and you might like a higher win rate with smaller magnitude winners. I might like a lower win rate but much lower risk on each trade, so that the expectancy is still high or positive, but the win side is bigger when I do catch a winner. Just depends. It's hard for me to arrive at that conclusion.
Okay. Thank you for the webinar and the awesome information today. Lots of good ideas. Lots of again, it's one of those things as a trader we don't even think about. So I appreciate it a lot.
Very cool. Thanks for having me on, Terry. Hope everyone is walking away with a little bit more of an idea of what they need to focus on in the next days of trading when they look at their plan. If they don't have a plan, to at least figure out what their risk plan is before they go out and trade live. And I hope you walked away with some information you can actually use, okay, not just theory. Good luck, everyone, and thanks for having me on.